Well, folks, it's 7 o'clock and we're going to go ahead and get started. Just a couple of things. If you could just keep your video muted, and then the chat, which is down in the center of the screen there at the bottom, is a place you can put questions in. We've had a couple already, and Glynn Tonsor will take this over. So Glynn, it's all yours.
Well, thank you, Rich. Get our slides actually showing here fully. Beautiful. Thanks everybody for taking time to join us this evening. I know everybody's busy, stressful, have lots of things to do. I hope this forum is informative. That is the goal. I will partially apologize up front. I'm doing my best, but I feel myself running on steam. I'm sure several of you can relate to that, but we'll plow through this as best we can. So you should have got a copy of these slides. You'll get a link. There'll be a recording on afterwards. I'm highlighting that because I'm not going to read every number on all these slides. I'm going to try to give you a big picture summary of what I think is going on, where we're at with these current challenges, and then open it up for Q&A via chat. So this should go without saying, but I'm going to kick this off by just saying we live in very interesting times, and several parts of this have changed since those of you that joined us about a month ago when I kicked off our session earlier in April. We now have this situation where the general public, not just those within the meat and livestock sector, but the general public is asking how we got to this situation. So sitting here as of today, we have a situation where there's disrupted flow of meat products to consumers. So going into the grocery store is a different experience today than it was simply a week ago. I anticipate components of that will persist during the month of May. And on top of that, we have restaurants across the country that are trying to open up. They've been given permission to, sometimes there's caveats and asterisks around that, but they're trying to go back to doing some version of more business, and they're struggling to find meat items for the menus. So that's being talked about, which is a notable change from a month ago. We also have challenges with, we have lots of livestock. There is no shortage of livestock. That clarification needs to be clearly stated in the media. We have animals, quote unquote, with nowhere to go, which is the bottleneck, so to speak, is what's going on here. And we have more and more calls for the government to step in a new way than we had maybe a month ago. And the new calls are, among other things, to facilitate euthanization payments, to compensate livestock producers that are putting down animals, and or to fund set-aside programs to encourage producers to put animals on a maintenance or a very low growth ration to smooth the flow and ease the pressure right now. Those are all different than they were a month ago. The net of that is we have increasing wholesale meat prices. I'm telling you, retail prices are to come, I believe. We certainly have declined livestock prices. And to note, we also have lower stock prices compared to the first of the year for some of the middle actors, the publicly traded companies. And that's of note as we try to dissect the economics of everything that's going on here. To go further, most of the drivers of what's going on that's changed in the last month is a bottleneck in the supply chain. And you should be seeing a little automation to give credit where this is due. That's actually a thing from Purdue University. For the last 2 or 3 weeks, I've probably been working with Jason Lusk at Purdue and Lee Schultz at Iowa State more than anybody else, trying to put out useful information. This is a useful just visual of the challenges of lots of different sources of livestock trying to go to a pinch point, which is the processing and packaging sector, which in turn send meat products out to a whole range of places. And when we have a challenge in the middle of that bottleneck, which is what's occurring right now with harvesting and processing, conversion of live animals into meat products, then the wheels fall off the proverbial bus, so to speak. And that's what we're going through right now. I have some reasons to be optimistic. We're in the eye of the storm and it's going to get better, but that is definitely the core situation facing the industry today. I don't have time to break down all of these things, so I included 2 slides to hopefully guide you, considered a homework assignment of sorts afterwards. Again, myself, Lee Schultz, and Jason Lusk in particular have been behind several of these resources. Every one of them I've included here. They are cross-linked from our Ag Manager webpage. I encourage you to make use of them. They tackle various aspects of this COVID situation. And here's a follow-up slide, which includes a little bit more of that, as well as some links to some lengthier webinars and interviews. The April 16th one, there was an update, a short update from the one you may have signed on to that I just posted. There's going to be more of this coming forward. I hope you guys find this helpful. And I want to kind of just blast past that, hoping to call your attention to it so you can make use of it in the future. I'm also going to highlight your attention to this resource. So Meeting Place Magazine has used Google Maps resource to put out this link. You guys can copy it at the top here to get an update on the status and basically a history over time of the different plant closures, announcements, and reopenings. I find that helpful to go to. While we have it right here, blue is good. So those blue dots that you see sprinkled across Kansas, they are not closed. There's not been major announcements on most of those facilities. The Alma facility is red. There has been an announcement there. But for our intents and purposes here, the major volume component within the state of Kansas, we've not had the same level of major announcements and closures that others have had as of this point in time. So now let me give you some numbers. USDA reports federal inspected cattle and hog volumes daily. It's important to note they put out a preliminary estimate and then it's subsequently revised. Those revisions are of note in the current environment we're at because I think they're struggling to come up with precise estimates, which is understandable. So we got to recognize that initial numbers are exactly that, initial. As of, this is particularly accurate as of Friday, we're down about 40% compared to a year ago on what we were doing on processing cattle and hogs. There's some preliminary signs setting here this week. The preliminary estimates day by day have shown improvement compared to last week, but then some of the next day adjustments by USDA have offset those signals. Why am I sharing that? I think we're at the low point. I certainly hope we're at the low point in terms of the number of animals we're able to push through, and then we're going to make some marginal gains going forward. There's mixed signals of that going on this week in the daily announcements by USDA. I hope that gets confirmed soon. The net reduction of 40% is confusing a lot of folks. We do not have 40% of plants offline. We've never hit that point. Obviously, that's good we haven't, but we have a 40% reduction in net flow. And that's an important distinction because the entire sector, not just those that have made announcements, but even those that have never made an announcement that they're having to slow down or certainly to close, are operating under different conditions. So every one of these plants that we're talking about, to the extent they can, has put in various measures of protection, separated the workforce the best they can, put in additional cleaning protocols, lots of things like that. The net 40% reduction is really a net of not just the closures and the partial reopenings, but the lower throughput that those additional protocols result in. I'm highlighting that because I don't see us being technically able to get back to the old 100%. I don't want to use the term ever, but certainly during the current and the near post-pandemic era, because I think several of these interventions are here to stay until we get truly post the pandemic stuff at least. So new max capacity, I think, has changed, not just short-term shrinking of the bottleneck. It's also important to note, the media has given coverage to the role of labor. I don't know why my slide go back. To the role of labor. Obviously, labor is important to the harvesting of animals and the subsequent processing and packaging of meat products. The industry is structured where we rely on labor. It's been that way for a long time. And the voluntary engagement of that workforce is core to this story as well. Lots of efforts are being put in place. We're testing more as an industry compared to 2 weeks ago for sure. I suspect we'll continue to have more of those improvements and efforts to understand the current health of the workforce. One of the things that I'm pretty confident follows from the presidential national declaration here, going to the Defense Act for the sector, is elevates this sector within the food supply chain. And in my eyes, kind of guarantees it remains a priority on the PPE front and other things. But what it doesn't do is sort of guarantee that the labor will show up. And that's what the industry is still working through. We can come back to that in Q&A if you want. But what I'm trying to impress upon you is this 40% reduction. Part of it's closures. Part of it is, closing and coming back at half speed and so forth. But it's also the effect of labor. All of those things affect the technical ability to run these facilities. I'm optimistic we're going to improve from here, but there's a lot of moving parts. Here's a visual. I told you about 40% down. On the left, you've got daily cattle slaughter. On the right, you got daily hog slaughter. These are weekday values. So I've taken out the Saturday ones just because that's lower and kind of throws scales off. And you can see here that for the good chunk of the first of the year, we were over 120,000 head of cattle. Right at the end of March, we were doing 118, 119, I have noted there. And then precipitously through the month of April, we declined. And then we hit a current low of about 72,000 here a week ago. 82,000 this week is an initial number, yet to be kind of confirmed. But embedded in my comment on maybe we've turned the tide is there's some initial signals that maybe these values are going to come up. Break that down for hogs. You can see we were right around 500,000 head a day, again, until right there at the end of March, and then very similar pattern. Why am I highlighting this? The ownership structure and various things are quite different between the cattle and hog complex, but the situation presented by COVID on challenges with labor and the need to try to separate those workers from themselves in an environment that's not really designed for social distancing is very common for both the cattle and hog sector. And not by surprise to me, then we see a very similar decline. I think that's instructive to keep in mind. Something that's relevant here, again, Lee and I, just my days run together here at the end of April, we pulled together this fact sheet you can find on our Ag Manager webpage, where we took a stab at trying to document what we think fed cattle flow might be. To paraphrase what we did is we took the weekly FI reported numbers that had been occurring up to that point, which are the charts I just showed you, basically just put into a weekly format. And we also took the cattle on feed report, which gives us some insight about the number of animals on feed for each of the last several months. And we can approximate how many were on feed for over 120 days, over 150 days, to get a sense of how many animals are needing to be marketed in the next 30 days or next 60 days under normal conditions. When we do that, we got to the point where we actually approximated before the month of April was done, and then the last full week in April came in at 425 head. That's what USDA reported. Our best estimate is a little over 500,000 head were carried into May that quote unquote should have been, or certainly were desired to be, sold by feedlots that weren't marketed, weren't harvested during the month of April. So we started May with maybe 500,000 head carried over. And then you'll see here, I've copied a table at the bottom, what June 1st might look like. And please note, this is a demonstrative scenario. We're projecting forward, lots of moving parts, but there's 4 different scenarios that reflect weekly volumes of 425 or 450 and potentially etching up to 500. Those are all what ifs going forward. I obviously hope we get to 500 soon. I hope we get past 500 soon. But there's a lot of challenges in doing that. The net story here is across those 4 scenarios, we're projecting that on June 1st, we'll have over 1 million head and maybe 1.3 million head that were carried over. So think the proverbial snowballing effect is well underway. Effectively, the same thing is going on in the hog sector. I just don't have the same resource right here to walk us through. And we also have the difference on the euthanization effort in the hog sector that we probably are going to talk about in Q&A. So now let's back up and understand the economic effects of all this. So when you have that bottleneck, you have depressed demand for livestock. So we have more animals trying to get processed than we're able to. That's bearish. That's downward pressure on farm prices. We've certainly seen that. Sidebar, we've seen less of that than I might have expected. We can come back to that in Q&A if you want. But given the 40% pull down in capacity that we're running at, I actually anticipated we'd push farm prices down even more than we have. So that's a little bit of a silver lining of sorts. But this also reflects the perishability of our supply chain and the growing discussion that we've talked a lot more during the month of April, and I think we're going to keep talking about it for the next several weeks at least, the move to maintenance rations in the cattle industry in particular, and euthanization, primarily in the hog side. The market effects of this are not fun for anybody. If I want to make something very clear, I'm not convinced anybody's winning from this. I think it's adverse for all players in aggregate, but they're most stark for those that are trying to sell into the last stage of the live animal sector. So those that want to push cattle into the feedlot are getting the adverse signals of the feeder cattle complex. Those that want to push pigs into finishing barns are getting adverse signals. And I suspect that's going to continue for some time here. We're also getting depressed flow of meat products, which leads to higher wholesale prices. That follows from the bottleneck again. We've also seen that, quote unquote, not all meat is equal. And this is important as a kind of a check on if the markets are working and sending signals the way they should, because in many ways I think they are. They're just massive shocks that we're working through. Is the difference in product that goes through retail and food service. It's been talked about a lot. It's introduced a lot of challenges for the industry to work through. And now we're sitting in front of trying to work back, try to enable some product going back through the food service at a time when we have less available, at least here early in May, to do that. The difference between fresh and frozen flows is central to current discussions. I want to limit how much I talk about specific companies, but those in the food service sector that are known to have fresh product are struggling to source at the moment more than those that can source frozen product. That's not necessarily surprising, but it reveals itself in this challenge. And consumer knowledge and comfort with different products is also going to be revealed. I'd argue part of the quote unquote hoarding on ground beef was because ground beef is a versatile item that lots of people are used to using in lots of different ways. So that's been supportive of that demand for ground beef. Conversely, other products that maybe they're not as comfortable with, we didn't see nearly the same run up on. And we're seeing partial passing of these price effects onto consumers. I think we're going to see more of that here during the month of May. Recent interviews, I've been saying it wouldn't surprise me if we had 20, maybe 25% higher retail grocery store prices during a good chunk of the month of May. Notice that is lower than the wholesale price increases, which I'm going to break down for you here in a minute. And the reason I'm highlighting that is I anticipate that grocery stores and restaurants will partially mitigate the flow of those price increases to consumers for various reasons that we could talk about. Last thing on my list here, which is very important, is I'm almost 40 years old. I think I've shared that in other settings. I'm very transparent. Let's throw that out there. It's my opinion that the general society, at least here in the U.S., is taking a deep look at the meat and livestock supply chain in a way that they've probably never done before in my lifetime. The exact outcomes of that are to be determined, but it gives me some serious heartburn that it's more than just getting through the current crisis. It's what adjustments might be coming down the pipe. So bigger letters here: lower farm prices, higher wholesale prices, reduced temporary availability of meat to consumers, and certainly a change in the variety mix and products that are available, the form that they get it in, and so forth. Add that up, it's not surprising, but it's definitely happening. We have escalating political and emotional situation, which is embedded in my personal heartburn part and the concern I have for the sector. So what's next? So now let's push forward. Again, I hope we're pushing towards a new normal of production, specific in the harvesting of animals. I'm going to remain optimistic that we are in the worst of it, and we're going to make progress from here. I'm going to put 85% on the table. Anecdotally, I don't think it's possible we can get to 95% of the old normal, given the amount of interventions that are in place. So I'm hopeful it's 85 or 90. So if we were at 60%, a week ago, that's still notable improvement in front of us. But please note that kind of caps the total capacity that'd be in front of us as long as we're dealing with the pandemic. The ability to do that and so forth is going to reflect a mix of efforts. So it's going to be a mix of pre-COVID pay, COVID active time, bonuses, maybe hazard pay, and then at the edge, an effort to displace labor and automate more things. That's a ball of effort that the sector is going to continue to manage. Some of those are easier to adjust in the short term than others, but I certainly think we're going to keep seeing adjustments plant by plant, company by company, trying to incentivize the workforce while also assuring that they are healthy and safe. But it takes all those. It's assuring they're healthy and safe. That's always been there, and that's the pandemic has certainly presented challenges on that front, but it's always been necessary to assure them as healthy and safe. But going further with the incentives to voluntarily, regularly show up is also got to be part of this story. Oh, sorry, I'm gonna be a hair long because I think these are important, but I'll try to stay on point a little bit. I think it's important to recognize that there's a lot of talk about second and third waves of the pandemic in the country. I'm an economist, not a health specialist or a public health politician by any means, so I can't predict if those waves will occur and or if we'll have shutdowns. But what I want to highlight is, to the extent they do occur, I don't anticipate the sector to be caught off guard as much in second, third, and future waves, because I think several of the interventions that are in place today will stay that way. So part of the trade-off on us not getting back to 100% of the old normal capacity is basically assurances that future waves, if they occur, won't be as damaging. I think that's an implicit trade-off that the sector is going to be making. There's going to be ongoing calls for the federal government to step in to compensate for euthanized animals, perhaps to fund these set-aside programs. I think that's occurring, going to continue to occur, excuse me. And I think the political calls nationwide, not just one state and not even just one political party, are going to continue to attempt to step in and quote unquote guarantee this never happens again. Personally, I have some pause on statements like that. That's the reason I'm interjecting it. There's two things I think warrant serious consideration in this story. One is there's a lot of discussion about should we have smaller and more plants, whether they should be owned differently or not and spread out differently around the country. That's a very big question that I discourage us from acting on quickly. And the reason I'm giving that word of caution is society, and notice I didn't say any one group, but collectively we as society need to carefully balance peacetime efficiencies of having economies of scale being core to our food system with a desire to have a food system that's more resilient and more, robust during stress times like pandemics. It's natural during a pandemic to ask these questions. I encourage asking these questions, but I discourage us being very quick and emotional to take action and forget a lot of the good things that our system historically has provided. So that balance must be struck carefully. The second thing, this one I haven't actually seen talked about, but I think it warrants assessment as maybe a compromise of sorts, is why I'm putting it on the table here, is I won't be surprised if there's also discussion for some version of governmental storage in this industry, different than we've had in the past. There's a long list of economic concerns I have with that. Storage is expensive. You'd have a new player being in the market, so to speak. We have to break that down. But at the margin, it wouldn't surprise me if some of these political interest discussions lead to, do we need to have more meat on stock going into unforeseen events so that we have a more backup supply? The parallel in my mind here is in some sense what we have in the oil industry. So the Strategic Petroleum Reserve has roughly 1 month's worth of typical U.S. oil consumption on hand. We generally don't have 1 month's worth of meat in the cold storage system. That's where that thought comes from. Please note, I'm not endorsing this, but I'm highlighting that won't be surprised if it gets talked about more. And it might be better than some of the other things that are talked about and strike a balance of the role of sort of being prepared and having less shocks in the future. So lots of big picture things are on the table that give me heartburn. Snapshot of the markets. So I'm going to be a little more geeky in the markets now that I've set the stage real broad. A month ago, I included this same slide with a different current week set of values. So it's not the last row on here, but the last row of actual prices is for May 6th or May 1st, depending on exactly which price series I'm quoting here. You can notice that live cattle and feeder cattle, they're both down about 17% from where we were if you go all the way back to early January. I'm frankly a little surprised we're not down more than that. We can come back to that if you want. Barrels and gilts and then early weaned pigs on the hog side are down more. That's a little misleading on the barrel and gilt front. The $36 price there is not a respective price for all hogs. We market hogs a little bit differently. We can come back to that in Q&A if you want. Probably what's most telling here is the early weaned pigs, so the 10 to 12 pound pig price. I have $5.91 as the price in there for May 1st. That's the weighted average price for that particular week. Note that's down 90%. That's a very strong signal from the hog sector, and it's not surprising to me that that signal is stronger than we see on the cattle side, because while not free and not easy, the cattle industry does have a few more ways to adjust the flow of animals and the growth rates and so forth than the hog side, and the markets are showing that for sure. On the far right, you can see here I've got boxed beef as well as the pork cutout. So this is our wholesale meat prices. Boxed beef is up over 100% at this point compared to early in January, and pork cutouts almost 63%. Lion's share of that increase has occurred in the last 3 weeks. So you can see it's all really occurred, not all, but most of that's occurred since the end of March on this particular chart. And most of that reflects the supply challenges that I've been alluding to in the bottleneck, which you're going to see on a figure here in a second. Here's the CME information to round this out. I'm not going to break it down. You guys can come back to this later if you want. The value of CME information is it's forward looking, so we can look out to the deferred contracts, compare them to the nearbys. So now let's spend a few minutes talking about, let me get my phone in front of me here, the wholesale meat complex. Beef cutout, that's what I have here. I have the composite, which is the dark blue in the middle. It's the one that I've put 3 specific prices on. And then I have the other primals. This is just for calendar year 2020. And you can see, comparatively speaking, things were calm through the first 2.5 months. And then we had the U.S. start making announcements. President Trump's declaration, the stay-at-home orders, those kind of things started to occur 3rd, 4th week of March. And you can see the ground beef demand spike that's embedded on this chart. So round and chuck are the yellow and the gray lines in the middle. You can see they come up there in towards the end of March. But then we have a fall off. And then most importantly, when we get to about the middle of April till now, every one of these primals has went, quote unquote, to the roof. Of course, that's pulled the composite cutout up. What's underneath that? We changed the story from previously being a disruption in moving product that we used to do export, food service, and retail, and sort of lost food service and we're struggling to move. In many ways, that was a demand center where we get the signals was changing. That was the challenge in March. Lots of logistical issues with that. the hoarding behavior coupled with toilet paper hoarding behavior and so forth was all part of that story. Fast forward to where we are in April going into May. Now we have changes in the demand story. We're trying to open back up food service and so forth. But we also have, and I would argue more importantly, a massive supply restriction in the near term. Quite honestly, I think the supply pull down is masking an aggregate demand decline. Stated differently, we've pulled supply down, pinched it tight enough that a negative supply effect is boosting these wholesale meat prices, even if we have negative demand going on in aggregate. Time will tell if I'm correct on the negative demand part. That's not a good thing for the industry if that's true, but I think that's part of the story here. And to give you some context on the shocks and the uniqueness and patterns that have been going on here, I picked a couple examples to make this point. This chart right here is taking choice beef, loin, and round primals, and I've plotted the ratio of the loin to round, again, just for the calendar year. And I'll note here that I included a tweet on this on April 24th, so I just copy and pasted it over. And the historic average, going all the way back to 2004, is for loin to trade at a 65% premium to round. There's only been 5 times in this series back to January of 04 where round was actually more valuable in the wholesale market than loin. And all 5 of them occurred that week of April 13th through the 17th. How'd that happen? Demand for loin product was quite depressed because of our food service decline in activity. And meanwhile, round is core to part of our ground beef production story. So that massive shift in displacement across primals was core to some of the patterns I was alluding to back in March. We've never seen something like that. There's a lot of examples like this I could break down. I'm not going to do 200 of them here today. What I'm trying to press on you is the entire industry is trying to adjust to massive shocks. This is a very massive shift within the flow of product and the value into that product. Here's the pork cutout. There's similar dynamics, although this is a little bit of a crazier roller coaster ride that goes back to earlier in January. Part of that is because the pork complex has been set up, is expanded harder with the hope of exporting even more growth in that front was anticipated pre-COVID. That put us in a position where we were hoping to send stuff to China. That shows up in the marketplace early in 2020 on this chart. Fast forward then to March, you have a similar story we had on the shift to grocery store and the challenges with that. What I'll call your attention to here is the brown line is the belly primal. And you can see that from about the second week in March till the beginning of April, the belly primal plummeted. Why? Belly is where we get our bacon product. Bacon, historically, about 2/3 of that goes through food service. That obviously did not occur in that point in time, and the buying at that point in time for the month of April for food service dried up drastically. We got to the point where we actually had days that the ham primal was higher than the belly primal. That is not normal, and that is not good for total wholesale pork values. Yet, fast forward to today, now we have the belly that is the most valued primal. So the line that's the race to the top that's broke $200 here as of this morning's cutout value was above $200 for belly. So we've went full circle, and this reflects the supply constraint, and I would argue as well as the desire on the food service front to have some bacon products as we attempt to open restaurants back up. Transition away from wholesale prices. Lots of discussion about how wholesale meat prices align against livestock prices. I've alluded to this already. I'm going to call another resource just to basically say another person I very much respect shares my views, or I share his, however you want to view that. Jason Lusk maintains a blog. He's been writing on these topics a lot. I encourage you to make use of his resources as well. Here's the link. But specifically, his May 4th blog breaks this down. And I agree with all the points he has there. I've made all these points in here, but I'm going to go a little further. If packers were, quote unquote, getting rich off this, one has to honestly ask the question why they wouldn't restrict supply, why they wouldn't restrict volume going through their plants and so forth more often and more normally. That sounds a little bit harsh, but I'm seriously concerned that some action is going to be taken that's the equivalent of shooting the industry's big toe off out of a reaction as opposed to a unbiased assessment. I'm not saying that to defend a sector. Please don't take it that way. I'm trying to be an analyst that's breaking down the economics of what's going on while reading the political tea leaves and trying to put out some unbiased information to guide better decision making. That's where that comment comes from. It's more than fine, and I fully encourage assessment all the time just to understand our industry, to add efficiencies, to make sure that signals are in place. There's always room for improvement, and I encourage assessment, so that's fine. But I think taking action just on emotion or reaction without really digging into some stuff is very dangerous, not just for the immediate players, but really the entire society, because protein is core to our food supply chain. That leads me to this point. I get the question quite a bit. Why don't we have a situation, Glenn, where X% change in livestock prices is matched by the same percentage change in wholesale meat prices, and it's matched by the same percentage change in what consumers pay? Well, that's never been the case. And in my humble opinion, it necessarily shouldn't. I don't like the term should. Should and fair are very misleading. They're emotional. But there's rational reasons that these different levels of the industry don't have the same price patterns. The supply and demand relationships are very different. As we move towards the consumer, we move from live animal to wholesale meat to final, retail meat in different places, where the input mix that goes into that final product is changing. That alone is going to change these percentage mixes. And you've got a big difference in the fixed variable cost setup across the industry, which has a direct effect on the ability of each level to adjust to demand signals, consumer preference changes, supply shocks, the like. The nimbleness is not the same across these sectors. Add it all up, I would never anticipate equivalent percentage shocks to play out and always be in sync and so forth. That hasn't been the case in normal times. Why would you expect it to be during crisis times? It's rational to ask questions, again, and to do some assessment, but please don't take action without analysis. Leads me to this point, and I'll apologize a little bit if I'm being preachy, but I have serious concerns, and I'm doing this for a reason. Maybe the second most often question I'm getting at the moment, beyond just availability of meat, is should we stop imports and exports? And please note, I put in bold red here, no, no, no. I think it would do serious harm to our industry. We import and export different products. Without trade, every major species in the U.S. needs to shrink its industry size. I can break that down for us if we need to, but that's the punchline. And I really feel like we're on the cusp of repeating history in several bad ways. That's core to my heartburn. To make my point, when you're bored, Google the Smoot-Hawley Tariff Act from 1930 and some of the actions that were taken on the front end of the Great Depression. They were very protectionistic. We had some of those tones occurring pre-COVID, and they're rearing their head again pretty strong today, and it gives me serious concern. One of the ways I like to use as a lesson on this and kind of the economics of work, and most of you have some kind of connection to the Kansas or certainly the cattle industry here, or the hog industry in Iowa, I could use either one of these, is let's consider the logic of feedlots being a big importer, a net importer of feeder cattle in the state of Kansas. What do I mean by net importer? We have more feeder cattle that go through feed yards here in Kansas than we have coming off of cow-calf operations within the state of Kansas. That's totally fine. I actually think it's a good thing for the industry and for the state of Kansas. Why do I believe that? I think that's a version of the U.S. cattle industry having comparative advantages play out. We have a handful of states, and Kansas is one of them, where we disproportionately have a larger share of our feedlot presence. Compare that to, we have cow-calf sector more distributed geographically across a lot more states. That reflects forage availability and the like being more spread, and comparative advantages and economies of scale and things along those lines being concentrated in a smaller number of states. Why am I giving this as that example? The economic logic behind that, comparative advantage, specialization, and the like, is core to the same logic on the value of international trade. And I encourage us to pause and not be irrational and jump before we do some serious analysis. LMIC gives us price forecasts periodically. Here's some for about a week ago. I'll just give you a couple examples. You can read the specifics later. As of a week ago, they were putting here second quarter fed cattle price for 5 market average 99 to 102. That's down about 15% from the same quarter last year. Of note, CME's up about $7 since April 28th, and there's some positive signs on low volume in the cash market. So hopefully we're going to push that range higher. There's reasons to be optimistic, I think, if we can truly make improvement on the bottleneck, circling all the way back to where I started this discussion. What about hogs? And I just have one quick comment here on dairy for our audience. Here's the numbers that LMIC's pulled together. Prices here in the second quarter being down 25%, national weighted base average, again, as of April 30th. In 2021, some recovery, but not a lot. They have prices down further year over year, all the way out Q3, Q4. A big unknown as we get later in the year is the effect of current euthanization efforts. We can come back to that in Q&A, but that's mainly a speculative discussion at this point. It's also note the CME lean hog prices have rallied quite a bit on the nearby contracts. For those that are tied to those, that could be beneficial. I'll wrap this up because I went a little longer than I wanted to. I encourage you to watch several things in the coming days and weeks. Here's a link to those public reports that are relevant to the core moving parts that I've been talking about. First and foremost is an assessment of our ability to harvest animals. So the first link is the daily and then the weekly summary from AMS. So those are the daily reported volumes. Below that is also the cutout prices and hog price summaries, not just hog and cattle. So livestock and meat price summaries are put out daily by USDA. And then the more monthly reports that are relevant are down there. You can see on May 12th, we'll get an update on what we think retail prices in April were. That comes out on the 12th. Cold storage report comes out on the 21st. So we'll have some sense of how we entered the supply situation in terms of the amount of meat going in. We had about 10 days worth of normal consumption in the cold storage system on April 1st. So we entered the month of April with about 10 days in very aggregated statement. That varies a lot across product. Not a lot of cushion in aggregate is the way I would interpret it. Cattle on feed report will give us a sense of the marketings and update on the fed cattle flow, an update on how many we think we're going to be carrying over on June 1st and so forth. The hogs and pigs report sort of parallels the cattle on feed in terms of giving us an updated inventory number, and that will come out. It's a quarterly exercise on June 25th. My final remarks. The meat flow is being altered. I encourage us to be very careful using the term shortage for several reasons. One is I think it's a May event, the month of May, and that in aggregate, there's a very strong chance that U.S. consumers are going to have more beef and more pork consumed in the year of 2020 than they did 2019. Now, to be clear, in the month of May, I think they're going to consume less, and maybe in June, less than they did June before. But for the calendar year, we anticipate more actually. And that's a natural aftermath of heavier weights, slight altering of the volume flow. The fact we pulled some animals in early into Q1 actually gave us more meat production in the first quarter than we thought we would. That's easing the current challenges a little bit. Add all that up, I think we're actually going to have more meat. I'm very confident we're going to produce more. And I think per capita consumption domestically will be up as well. The only way that would take the edge off that is if exports jumped even more than we expect. Putting a bow on this, the term shortage can be misleading and we need to be careful using it. It's really a near-term availability and a change in the product mix that consumers are going to see at a higher price in the month of May. The main economic impacts so far are on the production sector. Consumers are now to that point where they're going to see the changes and higher prices, but to date it's largely been on the live animal and the meat processing production aspects. Efforts to quote unquote fix the problem, solve the problem need to be approached with caution. I hope I made that point clear. Some reasonable balance between the efficiencies and the good in our food production system during peacetime, so not during pandemics, not during war, so to speak, needs to be balanced with having a more resilient, more robust system. I welcome questions and discussions, and society is going to ask those, but we need to strike a balance, not pivot too far. The pendulum could swing too far if we're not careful. And in doing that, as well as our views on trade and so forth, we need to recognize what the true actual comparative advantage of the U.S. swine and the U.S. cattle, and by extension, the U.S. beef and the U.S. pork industries are, because honestly, our global competitiveness is at stake. And if we quote unquote mess that up, we shrink the industry and there's serious long-term economic consequences. Now I'm going to try to end on a positive note. I've been a little bit Dr. Bear. I have lots of reasons to be concerned. I've even shared with you I have some heartburn over this. I'm trying to read some other things to remind myself, and I encourage you to do the same thing. I do believe society will prevail. I don't think this is the end of our ability to produce protein in the U.S. at all. I just have some concerns that some of the changes we're going to be making are far from optimal. So to keep some context on, pushing forward, I'm attempting to remain calm, have some bounded optimism. So put out some confidence and hope and context for folks while also being realistic. So there's no reason to lie, but you can also be uplifting while you do it, and to be analytical and reflect as opposed to just having emotions and reactions drive our behavior. I encourage all of us to do the best we can on that. I certainly have room to improve on that front. For those of you listening that are in position to guide the industry, I strongly encourage you to take my words to heart. I think another point that's being talked about a little bit more, but has a ray of sunshine in the story, is I think U.S. consumers are in the process of recognizing and reaffirming in a new way that we didn't see coming how important meat is in their diet. The discussion about availability and variety mix being as deep as it is an affirmation of that. And there's a possibility that post-COVID, that will be positive for sustained demand going forward. There's also a possibility that some households in the U.S. are going to learn how to use some of the previously underutilized products, and that would add value to carcasses and therefore animals. So there are reasons to be optimistic if we make smart decisions getting through the current eye of the storm. So with that, I apologize. I went about 10 minutes longer than I wanted to. I hope you heard my heartfelt comments, and I will proceed to go now look at the chat. I'm going to close this so I can. And while I'm doing that, I will invite my colleagues to join me.
Glenn, there's two questions, Rich Porter towards the beginning, and then the one I sent privately to you.
Okay, let me dissect it. Everybody out there doesn't want to read me and Rich going back and forth on if Zoom's working or not. So let me get this.
The first one, what are the reasons for the huge cattle futures rally yesterday and today?
It's a good question. I'm a little surprised it's occurred, to be honest. I hope it's a signal that it's going to spill over into larger farm prices this week and the weeks ahead. It's possible that it's a signal that the entire chain recognizes we need to keep economic incentives in place to keep product ready to flow. There's attractive wholesale prices to be had. So that could be what's going on. It's also possible that we are going to improve the capacity to operate in the next 10 days. That's part of that as well. But those are moving pieces. It's a long way of telling you, I don't have a firm answer that I would defend on why we've had the rally we've had in the last 2 days. It's quite surprising to me. I hope it continues. And as I said, I hope it spills over into the cash market as well, because there's farm side relief if that occurs. But it's stronger than I would have anticipated at this stage, is really what I'm trying to impress on everybody. Rich, the other one, there's more coming in now, but the one that was privately sent, I'll read it without sharing names. If packers knew the storm was coming, why weren't animals processed early to reduce bottleneck? My answer to that is we did that. So in the month of March, we had marketings that were hard. And if you break down the monthly cattle on feed reports and so forth, part of the reason the Q1 meat production was up, both for cattle and hog processing, there was a strong effort to push animals through the system before April 1st. And quite honestly, I applaud both species sectors for doing that. That actually gave us more cushion than we have otherwise. We're beginning to hear about COVID affecting beef protein around the world, especially in South America. How do you see this affecting the market in the U.S. in the short term and futures markets? Well, so even before those announcements, right, we have this bottleneck where we have a challenge in the ability to convert live animals into meat. That's core to the whole story, the core to the economics of what's going on. Anything that raises concern about the number of animals that are in the system, whether they're in Kansas, the US, Brazil, or the world, is going to raise concern on long-term, the amount of protein we're going to have, but it's also near-term can be quite bearish for the value of those livestock. So if you have COVID become a bigger challenge in Brazil, and if it spins over into a reduced ability to process, that's a critical component. So it's not just COVID cases that lead to a reduction in processing. It's that full story that has to occur. Then that would depress livestock prices in any region it occurs. That's what's happened here in the States. So it certainly has happened in Canada, by the way, as we talked about today. That's what I would expect to happen in Brazil if it did. And it would lead to a short-term reduction in the amount of protein that follows. I think it's short-term, because I don't envision us euthanizing market-ready cattle. I hope not to see that. It's hard for me to envision that. I think there's other levers of adjustment in many ways in aggregate that would occur. So it's a flow change basically on the beef side more so. Since your question is about beef protein. Next question. If live cattle prices are down while the price of meat and the consumer pays his way up, who's capturing the additional margin? So with all due respect, that question presumes there is an additional margin. All those observations reveal is that there's a gross margin. Now, I'm not defending any sector. This is important to recognize. Gross and net are not the same thing. So now it's going to sound like I'm defending a sector. Please, that's not my goal here. But you don't slow down chain on a fixed cost facility and put in additional protocols and spread out a workforce and pay some of them when they're not actually operating for the same cost you had in the past. So we need to recognize that gross and net aren't the same. Do I think net margins have improved at times in the packing processing sector? I certainly do. But it's very misleading to use gross margins because we don't have firm insight on cost. Point number one. Point number two, if you believe that capital markets outside of ag are reasonable, which that's up for debate, but I view them as pretty reasonable. So stock equity markets, bond markets, and the like, then I would suggest that one pulls up Jason Luft's blog that I included a link to, and I did it for a reason, and pull up the publicly traded companies that are embedded in that inquiry. And those stock prices are down since the 1st of January. So those outside the industry who are making bets on those companies don't see this as being profitable. So please pause on just presuming that a widening gross margin leads to being a winner. There's a very strong possibility that everybody from seed stock to me as an end consumer are losing, and the pandemic is to blame, not bad activity. It's also possible there's room for improvement in the system, and I endorse considering that and looking into that. That's fine. But jumping to conclusions just upon gross margins is very, very dangerous. Conceptually, how helpful could a fed cattle set-aside program be? So before I dive into that, I'll try to give a 30-second background. Drovers, I believe, is the one that was released. I saw versions of it before that. The concept in that possible program is potentially to have a federal government incentivize some volume of fed cattle to be put on a no growth or slow growth or a maintenance system, take them kind of quote unquote off the market for maybe 75 days. The intent, I believe, in that system is to ease some of this short-term bottleneck pressure. You're asking me how effective it could be. How effective it is comes down to the final details, how the incentives in whatever might be offered align with the willingness of feedlots to do that, and so forth. That sounds like a lawyer response, but that is important. So the details in that program and the efficacy of that program are hand in hand. So it's hard for me to tell you how helpful it could be, because I don't know if you'd have 10 head enroll or if all eligible volume would be enrolled in the first 10 hours. I could give you a story how it gives either one of those if the incentives weren't set up right. Moreover, we have to think about other consequences for the entire chain, not just those cattle that are trying to be sold, that wouldn't be in the next 75 days. So there's a lot of moving parts in that discussion as well. So question, can you expand a bit on the impact on the various cuts and how this impacts both imports and exports? Okay. I'm gonna go, so I'm still sharing my screen to answer your question. We're gonna go to this slide. Yeah, right here. So hopefully you're now seeing a slide, and it says sharing, so I think you're still seeing my slides. It says consider the changes in the fresh 90s and 50s. This would be from the beef complex. What I've included here is basically early May 2020 versus early May 2019 prices and volume information, differently for fresh 90% lean and fresh 50. What I want you to take from this while you're reading the numbers up there is A, the volume change. So 2020 is on top, and you can see there's a notable reduction in the pounds for both categories compared to same point in time a year ago. That reflects what we've already talked about notably. But then look at the price differentials and the range, not just the weighted average price. So the 90% fresh, the weighted average price is $256. That's up some from $223 a year ago, but percentage-wise, not a massive change. But the range around that price is 3x what it was last year. So the uncertainty and the variability and who you're doing business with is a bigger deal. Who agreed to what when, all those kind of things in that story. Flip over to the 50s, you will see, again, a notable reduction. It's about 2/3 the volume, 50% fresh compared to back in 2019. 2x the weighted average price, so 210 versus 104 back in 2019, and over 4x the range. Why am I highlighting this difference? The ground beef, run in March, coupled with the belief that ground beef is going to be something that consumers want to continue to have to the extent that we have product available, coupled with the shrinking supply of 50% here in the States, is leading to differential prices right here. Why am I bringing this specific example up? Because you mentioned imports and exports in your question. We historically import very lean product, from Australia and New Zealand in particular, or use domestic cull cow, highly lean product, to blend with trimmings, 50% fresh, 50% lean kind of products here domestically, to hit a given percent lean target. So for example, to produce an 80% lean ground beef package, that's a massive blending exercise, and the economics behind that lead to pulling product from multiple places. I will tell you that adds value to domestic fed cattle because we're finding a way to use the 50% lean and adding value to it by blending strategically 90% lean. The ability to do that hinges upon open markets, but you will see quite differential patterns depending upon what final product, in this example, ground beef or not, you see when you break it apart. I gave us the loin versus round difference as an example of that. Here's an example that's specific to the role of imports in particular. So we export, and the importing on the beef side is largely for this ground beef system that I just tried to walk us through. Next. Glynn, do you think the timing and flow of livestock feeding in 2020 will be effective enough to impact feed use? Well, I just told us that in aggregate, I think we're going to produce more. So I envision interest in buying feed to persist in aggregate. But how much of a disruption we have on the flow is a fair question. So how many hogs are euthanized will mitigate some demand for feed. How many cattle are put on a maintenance ration rather than a growth ration will mitigate some of that. I'm not optimistic that we can put many cattle on a true maintenance. I think you still have growth occurring at some point in aggregate here. And I'm also don't believe we're going to euthanize a large percent. I know that's not very specific, but I hope it's not double-digit percentage of the hog numbers. The largest number I've seen floating around is 7 million head. I obviously hope that doesn't happen. But if it did, that would be still less than 10% for the year, just to give us context. Not trying to be emotionless, but context is relevant. So I'm confident that aggregate feed demand is going to be there from this story. I think in the month of May, there may be a disruption, but I don't think it's enough to change big story on, for example, the economics of the ethanol industry, all of a sudden that being important for distillers' value and so forth. It's much more an aggregate story with a temporary flow disruption in my mind. Not John, Dan asked the question. I've read that we are importing meat while simultaneously euthanizing animals in the U.S. Is that true? If so, why should we allow that? So with all due respect, it's occurring because of economics and the challenges of the bottleneck. So there is no shortage of animals. I tried to impress us on that earlier. If you want to hear me say that in other ways with other analogies, please go to the radio interviews that I included links to earlier. We have more animals trying to get into the harvesting sector today than we're able to handle. That is the reason that we have euthanization going on in the hog sector. That's not the same story, although it's related, on why we import product. So we have a reduction in availability and certainly a throw off on the mix here in the near term of meat products. And our country wants to have meat. So you have economic forces that are pulling meat into the system the best they can, but we also have technical systems that are being challenged, and that is the physical ability to convert animals into meat. So there is no shortage of animals. It's a bottleneck challenge. That's why I use that analogy. That's why I include Jason's Purdue thing earlier. And that's how you get that net outcome. I was alluding to this through the whole thing. Society's asking the question, how can you, quote unquote, have a surplus of hogs and cattle and a, quote unquote, shortage of meat, is the way it's being phrased. And at face value, that doesn't make sense. I get that. It's not rational for somebody that just hears that in the news and moves on. But I'm doing my best to explain it to you, sir, is we're euthanizing animals because we can't convert live animals into meat products because we don't have the capacity currently that's operating. Yet there's an economic pull to have meat. That gives you that outcome you're talking about or observing. So you're recognizing it accurately, but I honestly think it's occurring for rational reasons. Why is the CME not caught up with the cash? I'm not going to speculate on that here. Some of those are old turfs that I don't want to get into right now at the moment. Mainly because I'm picking up on other tones that I'm trying to guard against. Do you have any opinion on the non-meat substitutes are faring in this environment? We're going to learn a lot more about that in the next 2 to 3 weeks. Most of you that are on social media or have email accounts where friends send you pictures probably saw pictures in the month of March where during the run at grocery stores, it was well documented that fresh meat in particular products were sold out at times. Consumers were filling their freezers and so forth, and leaving behind the alternative proteins. That was the nature of those pictures. That suggests to me that the average American that was trying to buy protein was not at that point in time interested or willing to pay the price for those alternative products. So some are viewing that as a very good thing for animal-based protein as a signal consumers don't want them. That might be part of the story, but please note what I told you there. That was during the month of March when we had the run on available proteins and consumers had at that point in time, quote unquote, sufficient volume and choice of beef and pork in front of them. Here in the month of May, because of the disruptions in the flow we're talking about, I think it's going to be more common that consumers go to the grocery store, whether it's in person or online through the grocery store, and they're not able to get their favorite cut or their second favorite cut of beef, pork, chicken. And some are going to have those alternative proteins for the first time because that is the protein substitute in front of them, or maybe reluctantly have it for the second time. I'm highlighting that because there's a real chance that that will win over some consumers, so to speak, and the share that's available to the alternative protein space will grow as a consequence of this. I don't envision in the near term that alternative proteins massively displace. Please don't take my comments out of context, but please hear me out. I don't think those pictures in March are the end of the story. I think here in the month of May, we're going to have another test in a different way of those consumer preferences. Next question. Are we about to hear from USDA, the payment process for distribution of government assistance? Your guess is as good as mine on those details. I can't really speak for the federal government. Do I believe the process will include limitations? Initial discussions were they would. This is a mix of, you have a timing question and an allocation question. Those aren't the same. On the timing front, the USDA efforts were announced after several of the stimulus efforts for the general population. And it's well documented that not everybody in the general population has received their stimulus funds. So the timing of getting those funds out has not been optimal in the eyes of several in society. I suspect several in the ag community will be frustrated with the timing as well from USDA. I hope to be positively surprised on that front, but my gut tells me there's logistical challenges on that as well, on making those distributions. These things aren't simple either. So I think you'll see some similarity, frustrations there. As it relates to payment limitations, there's definitely growing push by some associations to remove those. What I think is relevant there, if I was to give commentary for somebody trying to decide whether to keep the limitations in place or not, is there's a big difference in a program that's designed to help the most number of people versus help the food supply system. So help the most people, you put a cap in place so that you can cut checks to more operators. If you're trying to add security to food production, then you don't approach it the same way. That's not my decision to make. I usually make the comment somebody at a different pay grade makes that choice, but that's a political calculus that will be made elsewhere with a budget constraint reality, of course. I don't know if the payment limit at 125 that's currently there, is the one I believe is in place, will persist or not, but that's the implicit trade-off. Question. How much confidence do you have in LMIC's prediction of 140 range in feeder cattle prices in Q21? So let's go to it. So Q1 of, what was your question? 2021. Okay, so feeder cattle price in the 140s for the first quarter of 2021. How much do I believe that? I still think the world is going to want protein. I'm concerned demand has been hit by the recession, but I think Asia in particular is going to have an interest in importing beef, pork, poultry to the extent that we are able and willing. If I'm right on that, and we don't backlog feeder cattle more than we already have, so embedded in my optimism that we start processing fed cattle real soon and make an improvement, then I think that price could certainly happen. So a 140s is very reasonable if we get improvement from here. My concern, and if you make me bet, I have some of these concerns domestically, is that our domestic economy won't have the bounce back that a lot of people think it will. And my earlier noted comment that domestic demand is actually down, but it's being masked by the supply constraint. So we're getting the higher meat prices because supply has been pulled down harder than the demand. So the net effect is the supply pull down leaves prices up. If I'm right on that and the domestic economy is worse than some think, then that will quickly offset the global benefit that I just said is possible. So I think the 140s is possible, but I'm concerned that our domestic economy is weaker than some others might think. As a good economist, I talked through both ways of that. The 140 is reasonable where we sit today. So a couple comments direct to me that I won't share. Can you elaborate on your longer term concerns to which you alluded to in your presentation? So a couple of them. One is a societal wide populist notion that was building, questioning globalization, questioning why we do import and export the way we do. That was growing before COVID, and those discussions have been ramped up, and it's not surprising given the nature of human behavior. They've ramped up hard during COVID. My concern is the U.S., so not just for my family and so forth, but specifically to the livestock sector. My concern to the livestock sector is whether we're talking cattle, chicken, hogs, all sectors in the U.S. are the size they are with plans to be larger in the future compared to pre-COVID at least, with hope of exporting more. And we had X number of hooves in every one of those systems, sort of banking on the ability to not just maintain, but grow exports. And if on the table now is not just to cease exports, but to shrink or maybe at the extreme cease them, not just to stop them, but to cease them, excuse me, that's very dangerous. So the economic signals, if that occurs, will be stark, and we will have to very quickly shrink the size of our livestock industry with multiple spillover effects to the general economy, particularly rural economy, given the spillover that has to property values and supporting schools and on and on and on. So I'm really concerned that populism is growing and we're going to do more harm than good on the trade front, is the point of that comment. The second one, my bigger concern, is I think for the whole food supply chain, but certainly the meat supply chain, given the challenges we're in, we're going to ask the question, is a system that is sort of just in time, particularly for fresh meat, a short fuse, not a lot of meat in storage between live animal and consumers getting it, quote unquote, what we want, or do we want to put more safeguards in place? And to go further, part of those discussions is, would our systems be more robust if we had a larger number of small harvesting and meat processing facilities? The latter is a question of if, It's not been proven to me that that's a guaranteed improvement on robustness. It could be. I think it's a fair question. My concern is that some of those actions are going to be taken where the only thing we know is we're giving up some efficiencies of production that in normal times give us cheaper food that's really desired by society, particularly for lower income households that are very sensitive to price shocks, in hope of potentially building a more robust system. So notice how I responded to that. My concern is we make action that we know has a cost that is notable in hope that it might have a benefit. That kind of trade-off is not something I'm very comfortable with. So assessing things and figuring out if we can build a more robust system without unduly giving away efficiencies is what I would much rather see us do. So those are the two main things long-term I'm concerned about. So comment was made, payments end of May, beginning of June. Politics around payment limits. So one of the comments, so I'm not going to share names because these are privately, but there's been two comments made that I'll make the comment on and then respond so that person can hear them and others can. One's a question for me, in my opinion, what do I think policymakers can do to ease the current bottleneck while obtaining a free market kind of approach, capitalism, picking up on my tone that that's important. One that comes to mind, and we have to be careful how we structure it, but most of the efforts and discussions to date have indirectly dealt with the labor challenge. So they've indirectly dealt with it by euthanizing to remove animals coming to the system. They've indirectly done with, by proposing a set aside to reduce animals coming to the system. Potentially they indirectly deal with buying meat to add support to the industry, which you can question if we need to do that when meat supplies are low or not. But all those examples are indirect and they don't directly get at the labor challenge. The stuff that's been done that directly deals with labor challenge is helping gear up testing and provision of PPE and so forth. And I think that's great. We need to continue that. We need more of it. I think it's good for this sector that, to my knowledge, the only part of the U.S. food supply chain that has the president's order is the meat production chain. So that gives us that elevated priority. But please note that's specific to the testing and health component. It indirectly helps with the labor. So I could come up with, but they need some thoughts. I won't do it live here in a webinar. Some market incentives that nudge the workforce that would be both privately and publicly beneficial. Doing that could ease the bottleneck, get more livestock harvested, get more meat flowing, have lots of other positive externalities that several of the other proposals are kind of indirectly addressing. So to answer your question, I think some more direct engagement in the labor incentive marketplace may have a role. One of the other comments that was sent to me privately was set aside program more or less market distorting than direct payments. Again, it gets into the details. Set aside program does have market distortion effects. You're adding assurance on pushing flow of animals back, not just fed cattle, but feeder cattle. Those become distorting in seasonal patterns and the like. Maybe add some uncertainty to flows in different ways, blah, blah, blah. We could talk about it. So it definitely has a distorting effect. But direct payments do too, because direct payments change the economic calculus on making tough decisions. That's not a politically fun thing to say, but they do. So they both are distorting. Which do I think is more distorting? I can't honestly tell you unless I know specifics about how big the direct payments are, how they're split across levels, and how that compares to the exact details of a set-aside. They're both distorting to some level, and in many ways, that's why they didn't exist going into COVID, is because in a pure market system, there's components to that we're not crazy about. We're not in normal times. There are arguments to have each of those on the table. That's not my decision whether we should or shouldn't have them. I see the merits in each of them. But as an economist, I fully recognize there are distortionary components to each one. Are product safety issues being monitored for COVID transmission? So my understanding is, to date, there's no evidence that COVID can be transmitted through your food. Front and center, the core reason that that's widely talked about is going through food service drive-throughs and so forth has been a mainstay of societal response to this from the start. So that's how I'm going to respond to your question. I'm not aware of food being, able to transmit, but I'm not a transmission expert, right? I'm just an economist in the story doing my best. So you're welcome to dig into that more elsewhere, but I'm not aware of food being able to transmit COVID, and I haven't heard of any extra concerns on that front specific to the meat sector. I can see the value you see in free trade, but what if China is the only country with which we didn't trade in the future? That question came up in one of our past webinars, and stated differently in the past is, what if we trade, we have a global trade network, but we don't trade with everybody, so get beyond just China. That is certainly possible. I'll remind us that throughout history, all countries have differential trading arrangements. Those that were former colonies of a country certainly had different trading relationships with the quote-unquote mother homeland than other countries. So throughout mankind, we've had differential approaches to different countries, just like we have a different one with multiple Asian countries now, not just China. I think it's quite possible we will have differential terms with China than other countries going forward. If the U.S. can retain a fairly open approach to exporting things that we have a comparative advantage in producing, and most countries that are economically positioned to import them are doing so, then I become less concerned in aggregate about the populist notion, because we're still active, albeit maybe not with one of the most important big trading partners. But that scenario is much better than a hunker down and sort of put a concrete wall around all our, at least the 48 continental states. That's the extreme reaction of populism that I'm trying to nudge us away from. So, John, you asked the question. I think we could retain quite a few of the benefits of trade if we don't make progress with China, but we do with other countries. And that would be a positive situation compared to the stark one that I'm concerned about. So a couple compliments, thank you. While I'm waiting for a couple of those, if you have more questions and so forth, and we can keep going here. I hope you guys heard me loud and clear. I kicked off the session, and a couple of times we went. I'm honestly doing my best, trying to be unbiased. We're in very emotional times. So thank you for the comments. I'm not perfect. None of us are. So while you guys type a couple more in, Rich forwarded me on the registration list that included 3 or 4 questions at the time. Since I had them, I quickly included them in the slide deck. So while you're, at least while this is being recorded, I'll go on and address them. One was, will the government buy market weight livestock to be euthanized and landfilled? I put in here to be determined. I certainly hope not. But there is growing calls, politically in Minnesota in particular, but I think in multiple states, you're going to hear more about this for the next few weeks, particularly on the hog side. As euthanization occurs, I think we're going to have more discussion and calls for federal government aid. I don't have a progress report on the market investigation. I presume this goes back to, or the notion's comment back to the August Tyson plant, Holcomb fire. There's nothing official I can provide as an update. You can Google and search on that, and I'm not aware of a formal update at this stage. Can I include any specifics breaking down the cold storage supplies, breaking down what was already sold versus going to export domestically? The short response to that is the report itself doesn't enable us to do that. We entered April in aggregate with about 10 days worth of supply if it wasn't being exported, a little bit to your question. So at most, we had 10 days of cushion is the way I interpret it. But beyond that, I can't break it down much based upon what's in the report. Everything else would just be anecdotal expert opinion that you can't really pull out of the report itself. As it relates to phase 1 on the China free trade agreement, we kind of indirectly just dealt with that in the Q&A. We can track the progress on how the current volumes align with announcements. I suspect we're going to continue to be frustrated. What will be the impact on retail meat prices and product availability as grocery stores limit their purchases? Well, if you limit the purchases, we expect that to slow the flow, all else equal. What we don't know as much on the prices is to what extent will retailers, and soon I would argue restaurants, choose to eat some of the price increase. in the spirit of a loss leader to keep foot traffic to smooth the flow of prices for consumers. I think they'll do some of that. They've done it in the past. I think they will for broader business reasons, not just meat price reasons. I made the comment, and I included it here to reiterate it. I'm anticipating 20, maybe 25% higher prices in the month of May for consumers. But please note that is less than the wholesale meat price change. I tried to describe why that was earlier. We normally don't have the same percentage passed either way. There tends to be a mitigating effect both ways. Prices going up are partially passed on. Prices going down are partially priced on when we go from wholesale to retail. And I expect that to occur again. The last one that was submitted, this is more of an opinion and comment. You can read it, but I'm trying to respond to everything that's been submitted here. Historical packer margins, fat cattle prices at 10-year low, price of retail beef's not connected to live cattle. The quality of fat cattle is different. Ownership of some plants is not from the U.S. Feedlots, quote unquote, don't have negotiation power. Those are a lot of opinions and observations of different parts of the industry. What I put in here as a response is exactly that, is it's an opinion mainly comment. You ask what is needed, the submitter. That honestly depends on what the goal, how you want to approach that. So if the goal is social efficiency of beef production, there's a very different response to the supply system we have than if it is to protect or grow the economic well-being of one specific sector, whether that sector is seed stock or cow-calf or backgrounders or feedlot or packers or wholesalers or retailers or end consumers. Those are all different potential players one could pick out and prioritize, but you'll get a very different answer to what is quote unquote needed depending upon what the goal of the system is. I personally think we need a system that aligns incentives to produce products that the world wants and encourages industries to do that as efficiently as they can. That's a very broad societal kind of view, as opposed to picking winners and losers within the industry, is the way I think through this, because I think society gets better as a whole when we take that approach. But I'm very well aware there's lots of vested interests throughout all those different sectors I just listed that would like to change components of this to improve the well-being for their sector. Part of that's rational, but I'm not going to sit here and endorse changes that clearly do just that. All right, so now go back to the submitted ones here. While we do that, I'm going to go back to this slide. So before I go back through the last ones that are submitted, I'll remind everybody some of the things we've talked about are indirectly tackled. Resources that are cross-linked from my page on the Ag Manager website, and or for those of you on social media, the Twitter account, particularly my general media engagement. I tend to cross-tab it with Twitter. A lot of the stuff we've been talking about there is related. So one of the comments, I see two outcomes of COVID: more automation and more packing plants with fewer employees, some hybrid of the both. Which is more plausible? How does this affect the price of cattle? On the topic of automation, so Brett, I 100% agree that this experience is going to further incentivize the replacement of labor with capital investment. But a word of caution is prudent. The value of additional automation has grown during this experience, but there's been a value there for quite a while. So the entire U.S. ag sector has had labor challenges well before COVID. So the interest in making capital investments to ease labor challenges is not new. It's just been escalated. Why am I highlighting that? At the margin, I do think we're going to have some additional automation that follows from this, but there's a technical feasibility that's embedded in part of the reason we don't have more. So it's not just put it in place. We need to invest in developing better that doesn't sacrifice line speed. Maybe they can handle ununiform carcasses and product shapes and sizes better than the current abilities and so forth. So there's a need to improve the technical ability before there's a massive displacement. But make no mistake, there's a strong economic incentive to go down that path. The second part, more packing plants with fewer employees. You heard my comment on there's growing political calls for more and smaller plants. That's certainly possible to be more plants if that's where society takes us. Fewer employees may not be the outcome of that, though. So to the extent that there's economies of scale and allocation of labor in a bigger facility where you can specify effort, the more small plants we have, the more employees we might need in total in order to get the same production. So I pause on jumping on the fewer employees as we have more plants component. That may not be what you're thinking, Brett, but other people suggesting that are. Thank you, Rich. I think you can tell I need to smile. So I'm going to take the liberty to end with Rich Porter's comment. When will Call Hall ice cream be available again? And yes, it is related to the cattle industry because it's an outcome. I don't know the answer to that. I hope somebody out here does, and they can type it in maybe for us. I look forward to that, and not just personally. I look forward to taking my kids there to get them ice cream. And Rich and others that share a love of ice cream are welcome to join me for one of their ice cream cones, I hope, in the near future. So that's probably a good way to end it. Rich, thanks for doing that. I hope I didn't come across as attacking or depressing. I'm doing my best, and I hope you guys find it helpful. So with that, thank you for your time. There will be, Brian's adding, you can order it now. There you go. So place your order, Rich. Order a 3-gallon tub. Brian says we can do it now. So thanks everybody for their time, being respectful. I hope you find this helpful, and good luck in the coming days. Give your family a hug. Good evening.